Today we are doing this question. This question comprises of most of the parts that we need to cover in CFA. Okay, this question says Shankalani and Sons Limited is a coffee export company located in Eastern Uganda. The company is planning to acquire a new processing plant to add value to their coffee. The plant estimated to cost 5 million. So our invoice value will be 5 million. In Asia, transportation from Asia to Eastern Uganda will cost 2 million, and transportation, clearance and forwarding will cost 300,000 and UGX 600,000 respectively. The company has been given free land worth UGX 3 million. Now this free land will be an incentive since the company was not planning for it. It will be an incentive, but if at all the company was planning for it to buy it, it will be an opportunity cost by the government, where the storage building to the house plant will be constructed. Installation will cost 500,000. After installation, the plant will increase the company's labor cost by 300,000. So that will be an increase in working capital. The company has hired an expert to conduct a feasibility study and advise the viability of the project. Feasibility study that will not be included in our answers since it doesn't impact something on the installation of the plant. After installation, the machine will generate annual revenue. The annual revenue will be 80 million. Monthly operating expenses will include salaries of UGX 300. So these salaries are monthly, but yet the in sales is in annual. So we shall change these salaries to monthly by multiplying them by 12. Water of UGX on 100,000, so we shall also multiply 100 by 12. Electricity also. The company is in a 30% tax bracket. The plant will be used for 6 years. It will have a resale value of 300. That means the salvage value will be this and the useful life will be 6 years. All fixed assets are depreciated using double declining. So they're using a double declining method. The project will last for 6 years and the management's rate of return is 20%. So in the question they're asking us, construct a depreciation schedule in a sheet called depreciation and use it to determine depreciation expenses chargeable to cash flows each year. But and that aside, such questions like this, even if the question doesn't ask you to construct a depreciation schedule first and just tell you to go, the first thing you must always do is to first get the initial outlay and you get the depreciable value first before you get the depreciation. Okay, so let's go to our Excel. Water, salaries, electricity. They also told us that the bracket is 30%. Now let us first get the depreciable value. The depreciable value is good in our initial outlay. So we shall have the plant cost, $50 million, 5 million, and also we shall add the we shall add the incidental costs. Of course, we have transportation from Asia to Eastern Uganda. We shall have the clearance $300,000. We shall have the forwarding, which is 600,000. But do you have any other? It's the costs. Those are costs that are incurred while bringing the machine or buying the machine. And we're having installation also, because the machine had to be installed. Sorry, this was forwarding, and we shall have installation. Okay. Let's put this here. Installation. So we shall have total incidental costs. There will be sum of this to this, and then we shall have the depreciable value, which equals to sum of this and this. So our depreciable value will be 84. Depreciable value will be 84. Now we continue with our question, and after this we shall add any increase in working capital. If we have the increase in working capital because they said our labor costs will increase by 300,000. So there will be an increase in working capital. So we add it. And if we have any incentive, we'll less it. So we shall first less incentives. And the incentives we have land. We just put it as a negative. And then for then we shall add increase in working capital. The increase we have in working capital is land. Then if we have decrease in working capital, we also less it. If we have reduction in working capital, we also less it from here. Now we are going to get the total initial outlay will equal to sum of this and this and this. Sorry. The lumber cost is equals to 300,000, so our total initial outlay will be 57,000. Okay, now from this point, let's test first the depreciation schedule, since we have the depreciable value. Remember, we are always using the depreciable value to make our depreciation schedule. So it will have period. Okay, let's say it depreciation schedule for the company's name was Chamkalany and Sons. Chamkalany and Sons plant. We shall have our period. We have the depreciation, then accumulated depreciation, and we shall have the net book value. They told us it's for 6 years, so we shall have 0, 1, up 6 years. Then depreciation for they told us that we decline, so DDP telling us to take the cost. I told you the cost in this form, in this part we are going to take the depreciable value. Shall fix it. Then they're telling us to take the salvage value, which was 300,000. We also fix it. Telling us also take the life, and the period. Comma period, but the period we don't fix it. Don't worry for this now, it's because in 0 years the asset doesn't depreciate. We shall format cells to UGX. Then we shall have the accumulated depreciation, which will equal to the sum of this. You put a semicolon and you fix one of the two. We shall fix this. Then our net book value at 0 years will be a depreciable value, and our net book value is got by getting in the first year, get the net book value minus the accumulated depreciation. Then we fix the net book value. Press enter. So this is our depreciation schedule for Kalani. Now we shall continue with our question. We are finished with the initial outlay, and our total initial outlay is this. So we shall go on the intermediate cash flows. Now we should have the format of the intermediate cash flows in mind. The first thing we shall have the period. Remember, our period starts from 0 years, 2 years, 0 years, 1 year, to 6. And the first thing we shall have is the revenue. Revenue at 0 years is always a negative of the initial outlay. In the second year, we shall take the revenue they're telling us in the question, because they told us each year the revenue will be 800,000. We shall fix it. And then we drag. Okay. Then after the revenue, we shall less operating expenses. In the operating expenses, we shall have these annual operating expenses: salaries, we shall have salaries. In the first year, we don't pay salaries. In 0 years, we're not paying salaries. We're only paying it in the first year and the continue. So we shall fix this. F4. Then we drag and drop. We shall have another expense. We have water. We shall fix it. Then we drag and drop. We shall have another expense. This is electricity. Shall fix it. We have the total operating expenses, unless we have any other expenses. First check. Electricity, water, revenue. That's it. Then we shall get the total operating expenses. They will equal to sum from salaries, water, and electricity. Shall drag, drop. Okay. Then the amount we shall get here will be earnings before depreciation, interest, and tax, which will equal to this to this minus the total. Drag and drop. Now we shall come and less depreciation. Less depreciation. Our depreciation in the first year was and in the second year respectively, and in the third year and the fourth year and the fifth year and in the sixth year then we shall get the earnings before interest and tax, which will equal to this minus the value down. Shall drag and drop. Then we shall remember having the interest, which we don't have interest in this question, so we shall be going for tax. The reason why we get depreciation before tax is to decrease our tax or our income and have quite a smaller value compared. So we shall less tax. In the first year, in these areas, you're not going to get tax because we are not charged if we are getting any losses. We are not charged tax. So they told us that is in the 30% tax bracket. So it will be 30% times the value here. Sorry, we shall fix the B12. And then we say earnings after tax. There will be this value here minus the value of the tax. Okay. The earnings after tax. This first change is to format the cells to UGX. We shall add our depreciation back. After adding, we shall have the total cash out flows. Sorry, the net cash outflows. They will equal to this value here. They will equal to sum of this value here and here. Then we shall add salvage, but this is added in the last year. So our salvage will equal, we shall get the salvage value we are having, the salvage value we are having in the question, which is this, then minus into brackets, we get the tax bracket times the salvage value itself. And then we'll get the total cash outflows. They will equal to sum of this value to this. Okay, so we are done with our intermediate cash flow. Change this to UGX. Now we shall continue with the rest part of the question. It says, it's saying, using NPV and IRR technique, evaluate the viability of the project. We shall have the tool, value, and decision. Having NPV IRR. So for NPV, we have an inbuilt formula called NPV, and we shall take the rate on our RR, comma, and we also select from this to that. We shall format the cell to UGX. Then for IRR, because we have an inbuilt formula of IRR, and we shall take the values we are guessing from, we shall use the inbuilt formula of IRR, and we are taking from the negative 57 to this. So for the decision, it's all about using the if statement. We shall say equals to if, you open brackets, you put in your logical test. Let's say that this column is less than, as given in the question, as they provide us in the question, is less or greater than, let's say this column is less than, let's say it's greater than this column. Okay, you put a comma and you put these double quotes. Since it is a string, you say invest, you close it, you put comma, you put for another scenario, you say don't invest if at all it's otherwise. Okay, and then you close the bracket, you press enter. So here we also then use the if statement. You say equals to if, we put our logical test saying that if this column is below, is greater than our IRR. Okay, comma, you put the double quotes, you say invest, you close the quotes, you put a comma, you put the other side, you say open quotes, don't invest, close the brackets. Now let's continue with another part of the question. It's saying using scenario manager and data tables, NPV, determine the NPV if the IRR changed from 20%, 25%, 30%. They're telling us if the NPV, the IRR changed from 20%, 25%, and 30%. Okay, they're telling us to find the new NPV. Now we shall have our rate here and the NPV. Okay, so we shall highlight this and we go to press the data tab, go to what if analysis, data tables. So they want the raw input cells, but we don't have the raw input cell for now, but we have the the column input cell for percentage, which was 20%, and you press OK. Okay, so format cells to UGX. Okay, so data table is also done. Okay, now we shall continue with the number. It is telling us using scenario manager, this number is done. They told us make a copy of your cash flows and name it sensitivity analysis. Using solver, determine the IRR they should have required if they wanted the NPV of 500 or 50 million. We shall come and we make a copy. Press here shift and make a copy. Make a copy of shift 5. Sheet 5 2. Okay, then they told us to name it sensitivity analysis. Sensitivity analysis. Sensitivity analysis. Okay, then this is the copy of our work. The real work is still existing. Now they are telling us they want to see the values if we want the NPV to be 50 million. And if you look at our NPV now is this, and also the IRR is still this, is still 908, and its IRR, initial IRR is 20%. So they want us to determine if you want the NPV of 50, what should be the IRR be? So we get the things you need to change while doing the IRR, the NPV. Okay, the values we must change to. Okay, so we shall come to our data tab. We go to solver. Then in solver we will ask us to set objective of which column do we want to set. Okay, in this format they told us, as the question told us, if you want the NPV of 50 million, so we shall change the NPV part. You click here and you press NPV. Let's first delete this. Shall click on the NPV. Then to which objective you set the objective, to which value you set the value to 50 million. 1 2 3 1 2 3. So by changing which value, changing the variable value cell will be our former IRR, which was 20. Then after you press solve, you press OK. Now if you look at our work now, the IRR has changed to 57%, and also if you come here, the NPV has changed to 50 million. So that's how they use solver. Thank you for watching the video. For those who have not understood, you can always check, go in the comment section and you ask for any question, I will answer. Thank you.